Part 2, understanding premium decay. In part 1, we showed that the realized premium decay curve is very close to the theoretical one for at-the-money SPY options. Since most traders, except for Dr. Jim, sell out-of-the-money options, does the actual out-of-the-money decay also follow theoretical?
That is the question.
Let's go next slide. It's kind of a really good piece. It's long, though. Unlike at-the-money options, the theoretical decay for out-of-the-money options starts to decrease approaching expiration date. So let's take a look at this historical data. Basically, what we're going to show over the next bunch of slides is that there's a reason. One of the reasons and I'm not throwing Dr. Jim under the bus, but one of the reasons I didn't like the piece that he just did is we have mechanics. And in our mechanics, we focus on managing out-of-the-money options at 21 days or 50%. We focus on managing at-the-money options at, let's just say, 25% because they decay, because the decay rate's lower and you take more risk. The reason I don't like selling in the money options is because it messes up our mechanics.
That's fair.
Because you have to use out of the money mechanics and it doesn't make any sense. Let's go to the next slide. Typical tasty study, 45 days to expiration, 10 years of data, 16 delta puts, recorded the non-movement occurrences, stock price less than 0.5% away from the original stock price order entry. And let's take a look. Go to the next slide, John. So just like the theoretical curve, the out-of-the-money theta tapers off approaching expiration. This is due to the low probability of an option being in the money at expiration. The out-of-the-money theta tapers off. That means when an option gets cheap, it just kind of sits there.
Sure.
Because nobody wants to sell. It's not worth selling.
Yeah.
Let's put it that way.
The risk reward.
The risk reward isn't there. Let's go next.
Doesn't move in either direction, for or against, right?
Yeah. How does pure premium decay look for a variety of deltas? So we'll look at theta decay for 5, 10, 16, 30, and 50 delta-wide puts. Delta puts. If we hold the delta constant on a percentage basis, the further out-of-the-money options decay faster than the at-the-money options, and then they taper. So you can see here, the further out-of-the-money options decay the fastest. The at-the-money options decay, the at-the-money options decay much slower. That's why if you did this within the money options, it would be incredibly confusing, right? I mean, it would look like it's inverted. You can see here the speed of the out-of-the-money options versus the 50 delta option. The reason that we show you this graph is because now you understand why, you're beginning to understand why we manage the 50 delta differently than we manage the 5, 10, 16, 20 delta, even the 30 delta. Let's go next slide. Look how much longer it takes to get there. That's why. Over the past 10 years, even though further out-of-the-money options tend to reach 50% of their max profit more quickly, we need to consider the differences in premium between out-of-the-money and at-the-money puts. So when you look at the at-the-money put, it has $750 in premium. When you look at the out-of-the-money put, like the 16 delta, is $213. So the average money you make per trade is significantly less, and the return on your investment is significantly less. However, when you manage at 21 days, the same trend as exiting trades where profits exceed 50%, it looks very similar. So like you had the 750, 213, and then you have the 134, 61. It's almost the same. Instead of 150, it's 133. Instead of 75, it's 67. So on a nominal basis, the at-the-money options collect much more premium per day. Yeah, of course, you're taking a lot more risk. This is the symmetrical nature of trading options. You take more risk, you make more money.
Which is a perfect math model, which is the way it should be. Because a lot of time in other models or other places, you're taking more risk and you're not getting compensated with the reward if you were right.
That's exactly right. That's why we like this. Let's go to the next slide. So by controlling for delta, we can quantify the direct contribution of theta to a trade's P&L, return on investment, and premium to collect. out of the money options reach their 50% winner target much quicker than at the money options, which is why we manage strangles early, 21 DTs or 50%, and straddles at 25% of their max profit. That's why people that sell in the money options, you get a little confused because you think you should be managing much earlier, but you're really trading the premium,
Right.
not the actual. You're trading. All these numbers are based on extrinsic,
Right.
not intrinsic.
Right.
Okay, it's just to be clear.